how to trade moving averages. In this video, we will learn about how to identify trend directions, how to enter and exit a trade, and how to identify trend changes with crossovers. Let's first understand how we can identify the trend directions. For determining the trend directions, we must take into account the moving average time period. This depends on the type of trend you wish to analyze. The most commonly used time frames are 10-20 DMA, that is, daily moving average for short term, 50-60 DMA for mid term, and 200 DMA or more for analyzing long term trends. Let us understand this with an example. In this chart with a 20 period SMA, we can clearly see an uptrend. Now let us place a 60 period moving average on the same chart. Here we can see that there is no clear upward or downward trend. As you can see, shorter period moving averages are closer to the price movements and are faster to react to the change in the trend. The longer period moving averages will react more slowly to price changes, but it provides a more reliable indication for longer term investments. Now let us understand when to enter or exit a trade. You can decide this by studying if the prices are above or below the moving average line. Let us look at this chart for example. In this chart, the prices are above the moving average and it acts as support. When the prices pull back to the moving average line, you can enter a trade with a long position and set your stop loss below the moving average line. And in this chart, the prices are below the moving average and acts as resistance. Here, you can enter into a short position when the prices retraces back to the moving average line and set your stop loss above the moving average. Now let us see how you can determine the change in trend using moving averages crossovers. So, when you place two moving averages on one chart with different time periods, you have the opportunity to trade moving average crossovers. When a shorter period moving average crosses above the longer period moving average, it is generally considered to be bullish. Let us understand this with a chart. In this chart, we have a 10 period and a 20 period simple moving average. In our case, when the 10 period moving average crosses above the 20 period moving average, it is considered a good time to buy. And when a shorter period moving average crosses below the longer period moving average, it is generally considered to be a bearish indicator. Here, when the 10 period moving average crosses below the 20 period moving average, it is a good time to hold a short position. For any two time periods you choose, the principle of crossover remains the same. To summarize, moving averages are an important indicator which filters out the random price movements and helps you see the average value of a stock. They can assist in setting support and resistance levels and helps you identify and confirm the trend directions. If you liked our video, like, share and subscribe to our channel. And for more such videos, visit our website www.edelweiss.in. Thank you. Investment in securities market are subject to market risks. Read all the related documents carefully before investing.